Reliance Nippon Life regarding how the different factors are and which pockets hold better merit going forward?
Much, Ajay, for giving us all of those details. In fact, yes, Vinay, let's start off by talking about the overall sector as a whole. Can you just walk us through how you've seen the overall fundamentals in terms of credit growth for the banking sector shape up? You said that you are fairly confident now that the NPA woes seem to be tapering off. Do you think that that has been a key catalyst for growth?
Yeah, of course. You hit the nail on the, you hit the bullet absolutely right there. Basically, if you look at the banking sector from a context of last 4-5 years, India has probably seen one of its worst corporate NPL cycle in probably a few decades. And today, particularly over the last 2-3 years, profitability of a lot of banks has been suppressed because of higher NPLs in the system. If you look at how the future is likely to pan out over the next 2-3 years in the medium term, one, we are starting on a relatively cleaner balance sheet. Your colleague already said that a large part of corporates have started the deleveraging process. We have put new mechanisms in terms of bankruptcy and IBC codes to fast track some of these cases. And therefore, the overall impact of that would be better profitability and normalized profitability for the banking system as a whole, and particularly for the corporate heavy banks, which have suffered the brunt of the NPL cycle for the past few years. In that context today, valuation seems fairly reasonable, whether you look at them on an absolute basis, whether you look at them on relative basis compared to their own history. Therefore, I think stage seems set for banking sector performance for a medium term of say 2 or 3 years. Now on your question on credit growth, again I think we have seen some improvement there for the past few months. Some of it due to base effect, some of it genuinely happening, some growth happening in certain segments, particularly in the retail and housing sector, which has shown good growth over the past few years when corporate credit growth was languishing. There is no reason to believe that trend will not be able to sustain itself. One, because retail and housing and a large part of retail credit is a hugely underpenetrated segment in India, and therefore that story can continue for many years. And when it comes to corporate credit, now that a large part of deleveraging has happened and resolutions are taking place in the system, I believe in a few quarters even corporate credit growth will come back. This is dependent on, of course, the private capex story picking up in India, but we are of the opinion that in a few quarters you should see some steam coming back in corporate credit growth market as well. And overall in the financial system, as your colleague said, I think banks today have a certain competitive advantage when it comes to growth. Last few years had seen some financial intermediaries taking market share away from banks. I think we'll see a repeat of that over the next we'll see a absolute opposite of that over the next 2-3 years, and banks should be able to claw back some of the market share from these financial intermediaries because of their deposit franchise. So if you look at an amalgamation of all these factors, it looks like credit growth should improve from here, and particularly in the credit growth, the share of banking credit should improve compared to the past few years. So this is why we are fairly sanguine of both the credit growth and banking system outlook overall.
So let's talk about specific segments of banks as well. When you're taking a look at the PSUs, Vinay, what are the things that you like? What are some of the factors at play that you're tracking there? And would you at this point perhaps up the investment when it comes to some of the public sector names?
So again, as I said in my previous answer, if you look at the last 4-5 years, the brunt of the corporate NPL cycle has been taken by banks which 5-6 years back were corporate heavy in their balance sheet. And if you look at most of the PSU banks, more than probably half of their balance sheet was occupied by corporate loans of some nature. To that extent, as normalized profitability returns and as market gets more confident in the fact that PSU banks are now back in black and NPL trends are sustainably declining, we should see valuations catching up there as well. Also, one should appreciate the fact that even in these tough periods, some of these banks, particularly the large ones, have not really lost their deposit franchise, and their deposit franchise has been intact. And as I said, the value of deposit franchise comes to forefront when interest rates and liquidity in the system are slightly on the tighter side. To that extent, yes, we do like PSU banks, particularly the large ones, and ones where we don't see capital as a problem and we don't see equity dilution as an issue for shareholders. We believe valuations are on your side on these PSU banks, and one should selectively look at them.
Tell me what's happening with NBFCs, because post the IL&FS crisis, many of them have taken a beating. Having said that, quality has, remained isolated. So I'm taking Bajaj Finance out of this cluster. But what of some of the HFCs? They've really been thrashed out. But do you now find value finally emerging in there?
So I believe one has to be selective in the non-banking financial space, and the reason for that to me would be that, again, while fundamentals of system remain strong, and while a lot of these NBFCs have developed a certain competitive moat over the last few years and have created business models which are very difficult to replicate and which have their strengths, but when you compare the environment 3-4 years back to what's likely to happen today, I believe that banks have certain competitive advantage because of their deposit franchise, and to that extent, the environment on the macro side looks more favorable for banks gaining some market share back from some of these NBFCs. Then there are issues, small issues related to real estate financing. Some of the segments where these NBFCs are particularly have particular expertise in, like auto, housing, are seeing some sort of slowdown. To that extent, I think having a diversified nature of balance sheet today favors banks over some of these NBFCs. Again, but having said all this, as you mentioned, there are certain NBFCs which have huge competitive moats, which have customer franchises that can't be replicated. And one has to selectively look at those NBFCs as and when valuations become reasonable. They have become reasonable to a certain extent compared to what they were a few years back or a few quarters back. So therefore, I think now opportunities are starting to emerge in certain pockets of NBFCs as well.
All right. Thanks so much for joining us today, Vinay, and sharing your views on the banking and NBFC space. Let's also now go across to Jayesh as FY19